Hi, I'm Matt Badiali. I'm the editor of Real Wealth Strategist and Frontline Profits for Prosperity Research. We're a division of Banyan Hill Publishing. And I wanted to talk to you a little bit today about the oil market. I know that's something that's on a lot of investors' minds today. And, oil prices at the end of the year plummeted. Oil companies got beaten up pretty hard. Oil service stocks got beaten up pretty hard. Where do we stand today? Well, I'm really bullish on oil going forward. I'm bullish because I think the worst is behind us, and there are some fundamental problems that are going to be tough for the supply of oil to the world. So I think we should see supply decrease. I don't think we're going to see demand fall off the way people thought it would at the end of 2018. And so what you're left with is a pinch, which will drive oil prices higher. Let's start with the fundamentals. The problem with oil really began when the U.S. decided to pull out of its nuclear agreement with Iran. And what that did was it triggered a reimposition of sanctions on their oil exports. So it looked like in early 2018 that somewhere between 1.5 million and 2 million barrels a day of oil production were going to be cut off the market when the sanctions were imposed on Iran. What actually happened in November of 2018 was that anyone who wanted an exemption, who received Iranian oil exports, was able to get it. And so the pinch didn't happen. But in the ramp up to that, countries like Saudi Arabia, Russia, and the US rapidly expanded production to meet that potential hole in supply. Because if you cut that much oil supply out of the market just like that, it would spike oil prices up. It would be a real disruption of the global economy. So what in fact happened was the opposite. We ended up with a huge glut of oil. In actual fact, only about 750,000 barrels of Iran's exports were cut off the market. That was more than met by the ramp up from the US and Saudi Arabia and Russia. So we're left with a lot of extra oil, which pushed the oil price down. And at the end of the year last year, there was massive fear that the global economy was really going to grind to a halt, that it was going to slow down and dramatically impact demand for oil. So oil prices had this combination of oversupply and really negative sentiment, which pushed it well below where it should be. And that's why we saw oil prices so low. That's why we saw oil service stocks and oil production stocks get clobbered. Fast forward to now, and we have the U.S. Targeting a new country, a new OPEC members, Venezuela, with sanctions. Venezuela is a country that's very oil rich. They depend on their oil exports for their hard currency. They're currently in a financial crisis. Their inflation rate is astronomical. They have two presidents, and the U.S. has decided we're going to embargo their oil. That's a problem because it could take as much as 1 million barrels a day off the market, which will tighten up supply. At the same time, you have OPEC, what they call OPEC plus, so OPEC and Russia agreeing to cut production again. So they're going to further remove barrels off the market. And then you have, coming in May, you have a revisitation of the Iranian sanctions. So we'll see if the U.S. ratchets down their sanctions a little tighter this time. Because as I said, everybody who wanted them got waivers last time. The talk out there is that they're going to be much tighter this time. But right now, we can't trust the talk. We have to wait and see what actually happens. But that's potentially bearish for oil supplies, which will be bullish for oil prices. So we have those things happening in the world today, which are going to have a potential negative impact on supply. But at the same time, we have a lessening of a fear of a demand destruction from the global economy. Things are still moving along. It doesn't appear that we're going to see any massive shocks to demand. So if all things considered, if demand stays level and supply is reduced, we should see higher oil prices. Now, that said, I'm not going crazy. I don't expect oil prices to go to $80 or $90 a barrel, but I certainly do think a rebound into the $60, $65 range for West Texas Intermediate isn't out of the picture. I think we could see that by the middle of summer. So I am strategizing with that in mind. That's kind of how we're positioning our portfolio right now. So with that, thanks for watching. This is Matt Badiali for Real Wealth Strategist and Frontline Profits. Good luck and good trading.